Hi, my name's Eric. I'll be reading you selections from this week's Barron's magazine with an issue date of August 24th of 2026. It's produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We will start with Up and Down Wall Street. This column is authored by Andy Serwer, and it's titled, Bill Miller Was Once the Greatest Money Manager of Our Time. I used to be somebody, but now I am somebody else. Jeff Bridges, in Crazy Heart. Regret and redemption, conscious or otherwise, can exert a powerful influence over our lives. I thought about this during a recent conversation with Bill Miller, the one-time legendary mutual fund manager. I'm blissfully retired, he tells me on a call from Canyon Ranch in the Berkshires. Had I had a different life, maybe in the many worlds interpretation of quantum mechanics, the optimal thing to do would have been to retire by age 55 instead of when I did. What Miller means is he should have quit before the 2008-09 global financial crisis. Hard to believe, but it's been 20 years since the beginning of the GFC, the global financial crisis. By 2006, the housing market had started to decline, and subprime mortgages in default were climbing. By that December, at least one subprime lender filed for bankruptcy. Soon it would get much worse, with economic demons savaging low-income homeowners and Wall Street swells alike. Most licked their wounds and moved on, but for those close to the fire, like Miller, whose Legg Mason Value Trust was decimated in the crisis, the healing took longer. I think his investing genius and record is deeply underappreciated because of the timing of his departure from the Value Trust, says Chris Davis, chairman and portfolio manager of Davis Advisors. So what does Miller, now 76, make of things today? When you're in a bull market and close to all-time highs, there are always questions, he says. Today they relate to AI, socially, epistemologically, philosophically, and how much capital it's drawing down. I got that new book, 1873, to refresh myself on the railroads and the panic of 1873, he says. It's the time that most closely resembles now. You had a totally new technology that radically changed things, and that required vast amounts of capital. Capital goes to experiments on different things, and eventually some of it actually works. Most of the internet stocks didn't do very well, but a small number of them did fantastically well. Miller is best known for his fund beating the S&P 500 index 15 years in a row from 1991 to 2005. He was Money Magazine's greatest money manager of the 1990s, Morningstar's fund manager of the decade, and a member of Barron's all-century investment team. I contributed to this canon too, writing a profile of Miller in Fortune with the headline, The Greatest Money Manager of Our Time, published in November 2006, just as his streak was about to end. Gulp. His streak ending was hardly the worst of it, though. Miller then bet heavily on financial stocks like Bear Stearns and American International Group, AIG, as they were tanking. In 2008, the Value Trust Fund was down some 55%. Every decision to buy anything has been wrong, he told the Wall Street Journal at the time. It's been awful. Later, he was portrayed unflatteringly as Bruce Miller in the 2015 movie The Big Short. Miller stayed on as manager of Value Trust until 2012, and also ran the firm's Opportunity Trust Fund. But clearly, he had hit his expiration date at Legg Mason and left in 2016, buying out half of a joint venture he had with the firm and setting up Miller Value Partners with his son Bill Miller IV and longtime colleague Samantha McLemore. By the end of 2022, Miller the Younger and McLemore were running MVP's money, and the following year, Miller the Elder sold each of them the parts of the business they ran. McLemore folded her piece into her company, Patient Capital Management, based in Baltimore, which now has some $3 billion in assets under management. Bill IV kept the MVP name, which has just under $500 million, added a couple of exchange-traded funds, and moved to Sarasota, Florida. Miller probably doesn't get enough credit for redefining value investing. Traditional value investors look to orthodox metrics, price to book and price to earnings ratios, straight out of Graham and Dodd's security analysis. But Miller believes any stock could be considered a value stock if it traded at a discount to the present value of its future free cash flow. That steered him to tech companies like AOL and Dell Technologies, as well as Google, where he loaded up the truck during that company's 2004 Dutch auction initial public offering, which vexed many on Wall Street. Over the years, Warren Buffett's thinking about value investing has evolved closer to Miller's. Miller's biggest home run has been Amazon.com. Bill was highly criticized for not being a true value manager because he had invested in stocks like Amazon, said McLemore. I was in an investment club at Washington and Lee, McLemore and Miller's alma mater, when he came to speak, and he pitched Amazon. He said, "We don't know what real values are today because it depends on the future, and the future's unknowable. But the best values don't look cheap at the time because their prospects are good. Why would you ever exclude a class of companies that you know are the best value? Amazon is my biggest position," Miller tells me now. "I never sold it, only added to it. I think I own more Amazon than any individual whose last name isn't Bezos, including a good deal more than CEO Andy Jassy or anybody else at Amazon." Miller won't say how much Amazon he owns, but notes that Jassy owns 3.23 million shares worth about $834 million. Miller and Bezos both went to Miami Palmetto Senior High School. Miller's second biggest position is in Bitcoin, which he bought after hearing investor Wences Casares speak at the Allen & Co. conference in Sun Valley, Idaho. Wences recommended putting up 1% of your net worth in Bitcoin, which I did when it was trading around $200 or $300. I wish I had bought more. Here, too, Miller won't say how much he has, other than it is substantially more than 1% of his net worth. But if he bought $1 million of Bitcoin at $300, with the price now at $71,917, that would be worth $239 million. It took gold 5,000 years to get to $4,500, but Bitcoin made it to $71,000 in a few years, he says. Unlike gold, the supply of Bitcoin is fixed. Bitcoin may have no intrinsic value, but neither does a Honus Wagner baseball card or a Picasso. Miller owns a few stocks besides Amazon, such as biometric security company Clear Secure, where he had been on the board. I'm one of the larger owners. It's still significantly underpriced. He also owns the NeoCloud company Nebius Group, a fairly substantial position. During the recent software-as-a-service apocalypse, Miller bought beaten-down private equity firms' stocks Apollo Global Management, KKR, and Ares Management, all of which had exposure to software. He calls it buying into what I thought was an unrealistic panic, and they've all rallied since then. As well as Adobe, just too cheap, and digital design company Figma, which Adobe tried to buy. Miller has a large position in McLemore's Patient Capital, where he's a senior advisor. Its biggest holdings are Royalty Pharma, which buys biopharmaceutical royalties, Google parent Alphabet, and United Health Group. He also has money with his son, Bill Miller IV, who's 45, who in some ways is a chip off the old block, independent-minded, quietly gregarious, and baseball-loving. Miller IV is a Bitcoin fan too, though unlike his dad, he favors the energy sector these days, including his largest position, Crescent Energy. Its free cash flow yield is not being reflected in its equity value. And Cord Energy trades at a discount to book. The younger Miller also likes Figure Technology Solutions, which uses blockchain technology for consumers to get home equity lines of credit. Not what you would call a traditional value name at 32 times earnings, he says. Another characteristic of Bill Miller Sr. is the unique form of intellectualism he brings to investing. An ABD, all but dissertation, in philosophy at Johns Hopkins, Miller will cite the likes of William James or John Dewey, paleontologist Stephen Jay Gould, and Roman historian Tacitus. Miller, a former military intelligence officer, found a common ground between philosophy and markets at the Santa Fe Institute, SFI, a brainiac think tank which studies complexity. He was board chair there, where he has kicked around ideas with Nobel Prize winners, as well as the late author Cormac McCarthy. Besides supporting SFI, Miller has given $125 million to the philosophy, physics, and astronomy departments at Johns Hopkins, where he was on the board, as is his second wife, Heather Hay Miller, who was a notable consumer products analyst at Merrill Lynch decades ago. In 2024, Miller gave Washington and Lee $132 million, allowing the university to go needs blind in its admissions. And Miller is a minority owner of the Baltimore Orioles. I waste 3 hours almost every night or day that the Orioles are playing, watching them play 500 ball. I consider that almost a charitable or philanthropic thing right now. For sure, Miller has been wrong sometimes. Besides the GFC debacle, he stubbed his toe on Eastman Kodak and Enron. But he has made some epic calls, too. In an April 2023 interview, Miller said he believed Amazon stock would double in 3 years. It did, and then some, from $102 to $249 in April of this year. Today, Amazon trades at $261. No regrets there. Moving on in the Barrons of August 24th to the Streetwise column, authored by Jack Huff. How high can T-bill yields rise before tanking stocks? Vigilante is rarely used in a happy light. The Montreal Gazette had a story this year about a pothole vigilante, an area landscaper making secret repairs to neglected public roads, putting his asphalt on the line under threat of fine and punishment. But more often a vigilante's a villain or deeply flawed hero who skips due process to punish the unrighteous. That makes all this recent talk about bond vigilantes unsettling. If fixed-income anti-heroes are punishing spendthrift politicians by sending Treasury yields higher, will the stock portfolios of the innocent get caught in the crossfire? And if so, at what level of yield should we panic? Many investors seem to view 5% on the 10-year Treasury as a tipping point, and we aren't far off at 4.7%, up half a point this year. Rising bond yields can hurt stocks in multiple ways, tempting stock investors to sell and put more in bonds, raising corporate borrowing costs, and lowering the mathematical value today of money that companies will earn down the road. That last one can be particularly hard on go-go growth stocks with slim earnings and high hopes. There's only anecdotal evidence for the 5% tipping point theory. In 2023, the Federal Reserve had been raising short-term interest rates for more than a year, from near zero to over 5% to fight inflation. Longer bond yields had lagged behind on the expectation that high short rates would lead to recession, cooling inflation, and bringing rates back down. Suddenly, the 10-year Treasury yield ran up by a percentage point in the back half of the year, topping 5% in October for the first time since 2007. Why? Robust economic data convinced investors that the Fed would keep rates higher for longer than they had expected. Runaway government deficits added to the anxiety. I think so, anyhow. The bond market doesn't issue a statement with its exact reason. Stocks protested. The S&P 500 fell 10.3% from its July high to its October low, meeting, just barely, the commonly cited definition of a correction, with the biggest declines coming at the end, near that 5% Treasury mark. Coincidentally, Succession and Billions hit television peep shows into the lives of the ultra-wealthy, aired their final seasons that year. The writing seemed to be on the wall for stock bulls, although this particular writing said, "You're still up 192% in a decade." Then yields suddenly dropped, and stocks jumped 14% in November and December. The clear lesson from this sample size of 1, a 5% Treasury yield rattles stocks, but the market bounces back if you give it 2 months. But then there's 1966. President Lyndon B. Johnson was ramping up spending on both guns and butter, the Vietnam War, and his Great Society programs like Medicare and food stamps. Congress had just cut rather than raised taxes. Deficits swelled. Inflation soared. Bondholders balked. The 10-year Treasury yield topped 5% that summer and forgot to turn back, reaching double digits by the late 70s. Stock investors suffered a lost decade and a half, with valuations collapsing and the S&P 500, after subtracting inflation, losing more than 50% by 1981. By then, TV didn't look like billions. The drivers on taxi were always taking second jobs, and Archie Bunker seemed obsessed with the thermostat and the price of meat. Goldman Sachs made a study last year of how the level of bond yields affects stock returns. The relationship, surprisingly, was that there was no clear relationship. Stocks have shined during periods when the 10-year Treasury yielded less than 3% and over 6%. What matters, the authors concluded, is how quickly yields have changed and why. Bond yields seem to have risen recently due to sticky inflation, a resilient economy, and higher for longer view of the Fed, and runaway government deficits, which recently brought the national debt to more than $40 trillion. But again, the market doesn't give reasons. What's troubling about that last point is the comparison with 1966. Back then, markets were tripped up by yearly deficits exceeding 1% of the size of the economy and the national debt hitting 40%. Those numbers are now closer to 6% and 125%. I put in an only slightly panicked call to Jared Woodard, head of the Research Investment Committee at Bank of America. "I think 5%'s your warning shot, and 7% is the one that really hurts," he says of 10-year Treasury yields. He bases this in part on the 1990 yield run-up that set off Japan's lost decades for stock investors. To his eye, the recent rise in U.S. yields is no reason for alarm. Inflation swaps are unchanged on the year, which, given what's happened in the Middle East and in Ukraine and in budget deficits, it's kind of shocking, he says. So let's not talk about a loss of Fed credibility. Never mind runaway inflation, when every market-based measure we can find says there's no sign of panic or even incremental worsening. A 5% Treasury yield is unlikely to pull investors from stocks at a time of soaring company profits. Woodard reckons, especially when returns on long, safe bonds have stunk in recent years and look likely to continue to stink. Venturesome investors can complement their treasuries with peppier sources of yield or total return. Woodard likes emerging market bonds, fallen angels, or corporate bonds that are just a tick below investment grade, collateralized loan obligations, which are corporate loans sliced into tranches, with the AAA stuff getting paid first, and commodity strategies that dynamically rebalance holdings. For exchange-traded fund buyers, choices include Vanguard Emerging Markets Government Bond, yielding 6.1%, iShares Fallen Angels USD Bond, 6.8%, Janus Henderson AAA CLO, 4.9%, and iShares GSCI Commodity Dynamic Roll Strategy, whose yield varies. It holds short, safe bonds for collateral while buying commodity futures. It's returned 9.9% a year over the past decade versus 15.2% for the S&P 500 and 1.4% for the iShares Core U.S. Aggregate Bond ETF. Moving on in Barron's, with a look at last week and what's to come this week, we have the Review and Preview column. The Lakers Tax Shelter. In early August, former Walt Disney CEO Bob Iger and investor Josh Kushner bought a majority stake in the Los Angeles Lakers at a record $12.5 billion valuation, $2.5 billion more than the price just a year ago. That's a lot for a team that's probably not very profitable, in part because of steep player salaries. Why are pro teams getting nosebleed prices? Well, billionaires want trophy assets, and then there's the tax benefits. Since 2004, pro franchises have been considered Section 197 intangibles, says tax expert Robert Willens. Virtually the entire purchase price is considered an intangible, which can be amortized over 15 years. If the amortization deductions lead to a taxable loss for the year, each partner's distributive share of such loss can be deducted by him on his income tax return, he says. If nearly all of the Lakers' price is deemed Section 197 intangibles, not an unrealistic assumption, he says, the value would be recovered over 15 years at some $800 million a year. Joe Pompliano, who writes on Business and Sports, posted on X that the buyers can use Lakers' losses to shield hundreds of millions of dollars in outside personal income, such as capital gains from VC investments from taxes. For the privately held Lakers, $800 million undoubtedly dwarfs its profits. Madison Square Garden Sports, which owns the NBA Knicks and NHL Rangers, is public and reported $59 million in profits in its fiscal year, despite high ticket prices and the Knicks' championship run. That was written by Andrew Barry. Last week, in markets, the yen weakened further as Japanese bond yields hit 3-decade highs. There was no visible progress between the U.S. and Iran as the 60-day peace deadline ended. Stocks fell to start the week, led by tech, then rallied. China's economy slowed. Global bond yields rose. The U.S. 30-year bond yield hit a 2-decade high. Treasury then said it would buy back 10- and 30-year bonds. The dollar sank, gold and Bitcoin rose, and yields persisted. On the week, the Dow Industrials fell 0.9%, the S&P 500 1.4%, and the Nasdaq Composite 2.1%. In companies, the Trump administration is planning to tell allies to pick sides in the artificial intelligence race, the U.S. or China. Hedge fund Jane Street announced a $15 billion loss on a stake in battered AI hedge fund Situational Awareness in July. The case brought by 29 states against Meta Platforms for deliberately addicting children began in federal court. Walt Disney sued the Federal Communications Commission for violating ABC's First Amendment rights. Trials on a Merck and Moderna skin cancer vaccine reduced recurrence. Moderna shares rose 177%. Humanoid robot maker Yushu Technology, also known as Unitree, surged nearly 6 times in its Shanghai debut. In deals last week, Monte dei Paschi di Siena launched bids totaling $40 billion for Banca Generali and Banco BPM. Creditors, including BlackRock and Oaktree, seized MBS Group, a Hollywood production equipment supplier, after it defaulted on its debt. This week, on Wednesday, August 26th, NVIDIA, Salesforce, CrowdStrike, and HP Inc. will report second quarter results. NVIDIA is expected to post a bottom line of $2.09 a share, nearly double last year's July quarter tally, with overall revenue rising more than 100% from a year ago to $92.06 billion. On Wednesday, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for July. Economists forecast a year-over-year reading of 3.6%, down modestly from the 3.7% published for June. Monthly inflation should quicken to 0.07% from June's minus 0.1% reading. Stripping out volatile components like food and energy will probably show core inflation rose 3.2% on the year, down from 3.3% in June. The Atlanta Fed's GDP Now index will show its latest reading. The index currently forecasts 4% growth in the third quarter. All of that on Wednesday. On Thursday, August 27th, Marvell Technology, Workday, Dollar General, Dollar Tree, Best Buy, and Lululemon will report second quarter results. And on Friday, August 28th, Fed Chairman Kevin Warsh will speak during the Jackson Hole Economic Policy Symposium. He's expected to begin at 10 a.m. Eastern Time. By the numbers, 6%. That's the decline in U.S. consumer spending on Apple's App Store year over year in the second quarter. 55 million. The number of U.S. marginal workers who lack career prospects at their employer, some 35% of the total. 17.9%. China's July unemployment rate for non-student workers ages 16 to 24 as university graduates hit labor markets. $40 trillion, the amount of U.S. national debt reached this past Tuesday, a record, up some $3 trillion in the past year. Our first article, takeaways from retail's big week. Walmart's sales, tariffs, and inflation were in the spotlight, by Teresa Rivas. Walmart set a somber tone for the first week of retailer earnings, but that wasn't the whole story. From tariff refunds to price cuts, the quarter showcased a shifting landscape as the industry heads into the most critical period of the year. The big news was Walmart's sales woes at the Bentonville, Arkansas-based giant reported a same-store sales decline, the first since 2020. Target, meanwhile, showed some signs of life, reflecting its turnaround efforts. Reports also arrived from home improvement merchants Home Depot and Lowe's, as well as off-pricer TJ Maxx parent TJX companies and Ross stores, which reported strong sales and earnings growth. The docket's full for next week, too, with reports slated from Kohl's, Gap, and Best Buy, among others, so there'll be more data to come. These earnings are important for investors who are particularly keen on any clues that would reveal prospects for the make-or-break back-to-school and holiday seasons. Here are a few main takeaways from week one. All eyes on Bentonville. Walmart is a bellwether, not only for the retail industry but also for the economy as a whole, as consumers grapple with high gas prices specifically and inflation in general. The company's post-earnings tumble was a reflection of disappointing comparable sales, a measly 2.6%. The chain took a big hit from changes in pharmacy drug rules. Same-store sales would have risen 3.4% if not for the drug hit. But there was plenty of positive news, including market share gains across categories and impressive growth in alternative revenue streams like advertising and membership. Particularly encouraging were e-commerce sales, up 24%. However, the focus on comps showed that investors are looking past strong margins. Instead, they are laser-focused on the second half. Can Walmart, or any retailer, cut prices fast enough to bring in new customers and retain loyal ones? And at what cost? Then there's the tariff factor. Tariff refunds have made a muddle of margins. Although this phenomenon should be largely contained to the second and third quarters, it has still made most investors sift through recent margin results, as Barron's previously noted was likely to happen. While Walmart, which received $2.9 billion in its quarter, had been the only major company to quantify its tariff refunds, Billions in benefits are now embedded in other retailers' outlook, from Target to Home Depot, which received $994 million and $730 million respectively. Ross Stores also reported a tariff benefit of $253 million. These checks are probably hitting at an opportune time, given recent pressure on retailers, notably Walmart and Target, to lower prices. The coming quarters will show how many companies put the money to work. It's affordability, stupid. The ongoing affordability crisis weighing on the housing market is still a problem for home improvement retailers. Despite a nascent recovery in some parts of the country, the spring and summer selling seasons were underwhelming, and mortgage rates remain a moving target. So it isn't a shocker that Home Depot and Lowe's felt the pinch, with do-it-yourself particularly under pressure. There were glimmers of hope. Home Depot, which reported a same-store sales increase of 1.7%, noted that its shoppers are still going ahead with smaller projects. And Lowe's anemic 0.2% same-store sales growth was still better than some whisper numbers that are floating up from the street. Red flags for mall merchants. There may be concern about companies like Gap, Abercrombie & Fitch, and other specialty apparel retailers whose reports are up next. That's because clothing was an ultra-weak category for Target, with just 0.1% growth in the quarter, squeaking ahead of home furnishings. It also isn't a great sign that TJX's main division delivered only a 1% increase in same-store sales in the quarter. No proxies. Finally, apparel aside, it may be particularly hard this quarter to expect one retailer's results, Walmart may be the exception, to provide a clear line of sight for other merchants and their stock prices. For example, Target shares are up 69% since the start of 2026, compared with a decline of some 7% for Walmart. The State Street SPDR S&P Retail Exchange Traded Fund is up about 2%. It's all about the chain's comeback, not particularly a sign that the industry is vibrant. Likewise, it's tough to extrapolate TJX's results to other off-price retailers. The slowdown in comparable sales at TJ Maxx was seen in no small part as potential customer attrition to Ross stores. Ross reported that same-store sales soared 10%. The retailer posted net income of $851 million, including the tariff refund, from $508 million in the second quarter a year ago. Earnings per share were $2.66 on a diluted basis, compared with $1.56 a year ago. Elsewhere, Home Depot's relatively comparable sales strength may have raised hopes unrealistically before Lowe's second quarter report, which disappointed. Estée Lauder had a 5% organic sales growth that could be a good signal for beauty as a whole, but it undoubtedly also reflects the strength of wealthier consumers, as well as its own organizational changes. And second-half jitters. Looking ahead, consumers will probably keep focusing on value amid inflation's strain, rather than closing their wallets altogether. If companies use tariff refunds to lower prices, bargain hunters will have plenty of options, and more market share may be up for grabs. The back-to-school season is already poised to set spending records. To win, retailers need to work hard to bring in those sales, maybe at the expense of their rivals. And given its length, we're going to move to the cover story. We'll jump a few articles in between. A comeback for American manufacturing. Industrial companies could be headed for an AI-fueled revival. Our roundtable pros pick 10 stocks from Boeing to Vertiv. By Megan Lenhart and Al Root. American factories have been sputtering for more than 25 years. First came cheap products from China, then a reworking of global supply chains. The U.S. manufacturing sector's output fell from about 15% of gross domestic product at the start of this century to less than 10% today, as a new service economy came into its own. Made in USA seemed destined for the scrap heap. Whoop, not so fast. A new age of American manufacturing may be dawning, one that looks much different than the old one. Its most prominent feature, not surprisingly, is artificial intelligence. The huge data centers that power AI require staggering varieties of manufactured goods, from construction materials to cooling systems to the racks and stacks of the servers. At the same time, the end product of these centers, AI, is starting to improve manufacturing processes across industries, from candy makers to heavy machinery. Industry and tech are becoming intertwined like never before. Other forces at work? Global conflict is lifting the aerospace and defense industries, and many American companies are starting to replenish inventories after a long stretch of running them light. The upshot: the U.S. manufacturing sector expanded for the 7th straight month in July. In that month, the Institute for Supply Management's Purchasing Managers Index generated its highest reading since May of 2022, thanks to new orders and expanding production. More could lie ahead. Non-financial S&P 500 index companies are expected to spend some $1.8 trillion on new plants and equipment in 2026, up from about $650 billion in 2021 per FactSet. To see where this may be headed, and to identify investment opportunities, we assembled 5 experts for a roundtable discussion about American manufacturing. They laid out the potential of the revival and its limitations, and the group's picks, from big stalwarts like Boeing to specialist data center supplier Regal Rexnord, offer a solid roadmap for the future. The panel: Joel Gamble Copeland, General Motors' chief economist; Scott Davis, founder and CEO of Melius Research; Adrian Helfert, chief investment officer at asset manager Westwood Holdings Group; Adam Ozimek, chief economist at the bipartisan public policy think tank Economic Innovation Group; and David Strauss, managing director of equity research in aerospace and defense at Wells Fargo. These are edited excerpts of the July 21st conversation. Barron's. So, where are we in the revival of the industrial economy? Scott Davis. Coming out of COVID-19, we went into a period of rolling recessions. Now in the industrial world, we're coming into an era of rolling recoveries. It started several quarters ago on the capital spending side. You're not going to see that in employment yet. You're not going to see people building speculative capacity. But we are seeing tremendous growth in anything that touches AI capital expenditure. The entire industrial supply chain has seen rising capital spending. That's always the first indicator of a large industrial upcycle. From where we see it, the companies are spending. They're announcing onshoring plans. A lot of those facilities haven't broken ground yet. A lot of the construction labor and such is being used for AI right now. There's a little bit of a labor shortage, but we would say that the outlook, at least from the industrial complex, is probably the best we've seen in my 35-year career. Having been an industrial analyst from the mid-1990s on, I don't ever remember a time like this. Adrian Helfert's response: we're seeing positivity on new orders. Manufacturing is showing a little bit of growth, but not extraordinary growth. There's a large need for manufacturing growth based on reshoring and policy. You see things like new orders going up, but labor's not there yet. However, it's not a bad stock market outcome because manufacturers can increase operating leverage and automation spending. Adam, you're more skeptical. Adam Ozimek: I'm not sure how much of a revival we have. It depends on what outcome you're looking at. If you're looking at industrial production, we are making more than we did a year or two ago. We've seen a slight bounce back. Manufacturing real GDP growth is positive, and that's good news. But if you look at the goals that trade war advocates set out for policy, we're not really seeing movement there. Manufacturing as a share of GDP hasn't moved up. Manufacturing employment isn't declining anymore, but it is still down. In terms of those types of macro outcomes, I wouldn't really call it all that much of a revival. I'd call it more like a pause in the decline. Joel, how about you? Joel Gamble Copeland. The traditional measures of whether or not we're in a manufacturing boom, our overall output, employment, those kinds of measures, may not apply as well anymore. Some of the transformation that's happening in the auto industry, but also across several industrial industries, could be measured on a different set of metrics. If we're going to see a kind of boom in U.S. manufacturing, we're talking about a different kind of transformation of how you run your business. It isn't just, can you produce more widgets? It's, what do those widgets look like from a technology standpoint? And what does your production process look like? Barron's. In other words, we're talking about a jobless recovery? Davis. Unfortunately, data centers don't create a lot of jobs. So I don't think we're ever going to be able to sit here and tell somebody that a manufacturing renaissance is going to create a tremendous amount of jobs. Instead, we're very positive on the automation players. The robots are coming. U.S. robotics companies are probably a little behind. If you were going to make a bet today on who's best positioned to win in robots, it may actually be China. Barron's. So robots will solve the labor shortage? Is that a bad thing? Ozimek. Every industry likes to say they have a labor shortage at all times. What employers mean is they can't get enough workers they want at the wages they can pay and remain globally competitive. There will be industries facing that kind of crunch. That will be tough if we're going to be more restrictive on immigration going forward. High-skilled immigrants are extremely important in strategic manufacturing industries. When you're talking about an industry that's volatile, and you don't have this long-run commitment to growth, it's going to be hard to get people into that industry. Sometimes there'll be a manufacturer that has spent a long time declining and laying off workers, booming and busting. And then they struggle to hire because workers don't believe that the factory is going to be there in 10 years. Gamble Copeland's response. Investment and technical skills for our workforce are really important. We're doing a lot of retooling of existing facilities. We're bringing some more capacity online in the U.S. that was previously elsewhere. And so for us, it's not a question of how many workers to hire, but what skills does our workforce need to be able to meet the product plans that we have for the future? Barron's. Labor problems will be with us for years. What's the near-term outlook for the manufacturing sector? We have seen the beginnings of a synchronized industrial recovery in 2026, with a very likely full recovery in 2027. Orders for the industrial companies that we track were up 26% last quarter, 18% the quarter before that. These are big numbers, far higher than what we're used to seeing at this point in the business cycle. For those who are a little skeptical, I think it's a little bit more of a timing issue. We are looking at a huge increase in capital spending. Mega projects, which are those over $1 billion in size, now exceed $2 trillion in total by our count. And that's a double over the past 2 years, and 10 times the announced spend of just 5 years ago. The upside extends beyond traditional data center suppliers. It's things like life sciences. We're also seeing a big bet on onshoring because of supply chain challenges that started with COVID and just continue as conflicts emerged around the world. Gamble Copeland's response. For the auto industry, we still have consumer demand holding up pretty well in the face of quite a bit of uncertainty over the past several years. Geopolitical uncertainty, policy uncertainty, and the war in Iran have weighed heavily, but we've seen pretty strong demand. We've seen folks still coming into the market to replace their vehicles. Truck demand has actually been holding up pretty strongly in the first half of this year. For us, the strategy is really about execution and flexibility. In a world in which there are so many different exogenous shock, so many black swan events that you're starting to wonder if it can be called a black swan event, right? You have to have a strategy where you have a business that's flexible enough to be able to navigate and pivot. Ozimek's response. The trajectory is influenced strongly by policy, and policy is wildly uncertain. We had Liberation Day tariffs, which were revised within days, then declared unconstitutional, replaced temporarily by Section 122 tariffs, and now replaced by a different set of tariffs. Businesses need certainty, and certainty has a huge impact on investment. With steel and aluminum tariffs being high, it's difficult for businesses to build and expand, and that's reflected in the administration's gradual walkback of those tariffs and gradual expansion of exemptions. Good policy can help, bad policy can hurt, and I think the trade war is bad policy. On the other hand, you have really strong demand growth as a result of the AI build-out, and this is clear in the data. Industries that are providing inputs to AI data centers are seeing strong demand. They're investing, they're expanding. The electrification of the economy is helping battery production. All those things are tailwinds. Barron's. So, what's good policy? We're a net exporter of aerospace. The idea that we're going to tariff aerospace components coming into the U.S. didn't really ever make much sense. It's not completely put to bed yet, but it seems like the regime that's been in place for a long time, where we don't tariff aerospace goods, is going to remain in place. Aerospace is a relative winner in the current environment. I wouldn't expect anything to change from a tariff policy standpoint. From a defense standpoint, and the government selectively investing in these defense companies, we'll see how that plays out. We're in that place in part because there's been underinvestment in the defense infrastructure for quite a long period. At this point, we're trying to kind of throw money at the problem. Barron's. The defense budget is growing. That's a positive, right? Strauss's response. Defense policy budgets are very much determined by who's in the White House and who controls Congress. All the industry is looking for is some sort of certainty to be able to make these kinds of large capital investments. That kind of runs counter to how the process works. Even though the administration is making a lot of promises about investing, it's still an annual appropriations process, and Congress controls the power of the purse. The industry wants to make investments, but it's hard to get a lot of certainty and predictability, just given how the budgetary process works, and the uncertainty with midterms, and then who's going to be in the White House after 2028. Davis's response. CEOs don't have time to wait for policy to become certain anymore. They waited, they delayed, and now they have to make decisions. And every single one of them that I've spent time with has stopped tiptoeing. They need to make a call now on where things are going to go. I've seen a greater level of optimism and positivity in the past several months than I've seen in a very long time. Companies that were notoriously bearish are now saying there are green shoots. Construction, which wasn't supposed to recover until 2028, is recovering. Less than 20% of the total end markets that we cover are still in recession. That includes sectors like agriculture and heavy-duty trucks. We could have a synchronous recovery in 2027. The AI halo is a big deal. There's a lot of purchase orders coming in on the AI side. Barron's. What are some of the longer-term issues you see? Helfert. A key question is China. Some of the Chinese AI models are producing nearly the same quality as our high-level models and end up pricing about 10 times cheaper than the US. If we don't win on AI, and low-cost AI, we risk seeing a new round of outsourcing related to AI-infused machinery. When we talk about AI-trained robotics, China's already capturing the largest share. Davis. Technology converging with industrial products is crucially important. There's a massive convergence. 3M, for example, isn't a traditional equipment supplier, but happens to be manufacturing a critical component called electric optical beam technology that Microsoft is reportedly deploying in its data centers. This could become a meaningful product launch for them over time. There are similar stories for a much wider list of industrials. We'd consider the industrial sector broadly to be the picks and shovel suppliers for the AI build-out. 3M is developing a technology for Microsoft, not Microsoft developing a technology for 3M. It's gone full circle where the industrial economy and the tech economy are one. We're going through a new evolution in manufacturing production. I'm talking SpaceX. Traditionally, Toyota Motor, one of Joel's competitors, has used Kaizen strategy of continuous improvement and just-in-time manufacturing, which contrasts pretty significantly with the SpaceX-style manufacturing. Elon Musk has been this visionary CEO destroying $60 million machines and learning from the failure. That's the new style. Speed of innovation trumps quality control at the front end of the process. The same kind of thing goes with automation. Automating existing processes doesn't answer whether those processes still exist. SpaceX asks, does this process even belong, and does it matter? They err on the side of deletions and adding back. After that, they automate what they must have. Barron's. How does all of this change investing in manufacturing? Does investing become harder or easier? Ozimek. I do think it can be easier to identify which sorts of technology are going to be winning. I think the easier investments are where you can pick things that are sort of upstream to electrification, such as demand for copper. It doesn't really matter which company wins, knowing that demand for copper is going to be strong as the manufacturing sector increasingly moves towards electrification and vehicles move toward electrification. That's a winning strategy. Investing in basic inputs into batteries and companies building the transmission systems. Those are sort of much more reliable bets. Davis. There's a lot of truth to that. One of the reasons why I like our sector is that we're arms dealers to the tech world. So we don't care who wins necessarily, we're selling to everybody. Look at what's going on in big tech right now. Who spends the most and innovates most effectively is going to win. But you don't know who that winner is necessarily going to be. We always tell people, just follow the money. AI CapEx is going to be 52% of total S&P 500 CapEx in 2027. So, when people talk about how the stock market is one big bet on AI, I think that's actually true. You have to believe that there's a change going on here that's meaningful and has sustainability to it. It does feel like AI has something sustainable from thematic perspective that's going to catalyze a tremendous amount of money being spent. Ozimek. I would be remiss not to describe the scenario where AI is a bubble. I say this with a full disclosure that my portfolio is not short any AI companies. In the history of computing and software, every generation things got smaller and cheaper. And at first, it seemed like the smaller, cheaper thing wasn't going to matter because it wasn't as fast, wasn't as powerful, wasn't as high-end. And so in every turn, these smaller, cheaper inventions were dismissed as not serious threats to bigger, faster machines. You have to worry something like that will come for AI. You can already see the threat from the open source models that are smaller and obviously open source, so they can be free. Will it be the case that these leading-edge, very expensive models that are powered by a large data center are disrupted by models that do pretty good and are smaller and cheaper? Well, it's a possibility we can't dismiss. Barron's. So, what is the winning manufacturing strategy? AI? Something else? Davis. It seems to me you have to merge AI and manufacturing. At the very least, AI is a productivity enabler. AI is tremendously exciting if we can get past the cybersecurity risks and challenges. Not necessarily easy. When people think about AI, they always think about eliminating jobs. What we've seen so far is that it enhances the existing employees and their capabilities, as opposed to replacing them. AI makes them more effective and more productive, and that's the holy grail in manufacturing. Ozimek. AI is potentially very important for manufacturing, but I believe that the AI diffusion through manufacturing is something that's going to take time. It's one of the things that makes me not think we're on the verge of 10% GDP growth. AI can help, but AI needs to be diffused, and so that will ultimately be a constraint. Barron's. There's more than AI? Ozimek. When I think about how the U.S. can grow its manufacturing sector, I think of foreign direct investment, high-skill immigration, and institutions to spread knowledge of best practices. When GM wanted to learn from Toyota about lean production methods, for example, they would send executives to the Fremont, California plant to study, then take that knowledge to other GM facilities. That's a case study of knowledge diffusion that's worth thinking more about. Gamble Copeland. I think in an ideal world there would be knowledge diffusion from Chinese companies to U.S. companies. But I'm highly skeptical that that would actually happen in practice, especially given many U.S. companies' experiences in China. I think China has excelled in gathering technological information from partners or ostensible partners, yet China would be very remiss to allow the same thing to happen, to allow potential competitors to gain a competitive edge. Strauss. We have to keep innovating to stay ahead of China. There's plenty of room for additional innovation, automation, and productivity in terms of how we build airplanes. China's aggressively trying to catch up to where we are on the aerospace side of things, but I don't think that's set to happen this decade or even next. It would be even beyond that. But much like they've done on the auto side and high-speed rail, they're trying to do the same thing in aerospace, and they have big aspirations. Barron's. What are the broader implications on the recent rise in overall CapEx? Helfert. If the U.S. economy is truly going through a reindustrialization of any sort, there are some estimates that it's a $2 trillion CapEx spend. We would have to spend significant amounts to get our capacity up to be more self-sufficient. We don't have the capacity to close our trade deficit in manufactured goods. And if all of our manufacturing facilities were operating at capacity, we would still be significantly short. We're going to end up with either higher growth rates in manufacturing or more complex factories. And as an investor, when you have more complex factories, the companies that are keeping those complex factories running are going to become more valuable. Davis. We spend a lot of time talking about AI. What I think we don't spend enough time talking on is about the underinvestment for 25 years in the U.S. of fixed assets like roads, bridges, rail, ports, factories, supply chains, electrical infrastructure, and even water management. We can't ignore the fact that money needs to be spent in all these other areas. I actually think it will, and not necessarily because it's a nice to have, but it's actually becoming a need to have. Things are breaking down. What it means to us is that a lot of money has to get spent. It needs to get spent, and it's going to have to come from all levels. Barron's. And that money should help some stocks. Let's move on to stocks. Scott, tell us what you like. We're looking at the entire data center supply base. Vertiv Holdings is a pure play. It's pulled back about 20% in the past couple of months, same as many AI stocks. We'd buy it at that price all day long. It's the pure play electrical and cooling supplier to the data center complex. It's impossible to be bullish on AI in any way, shape, or form and not own that. They don't necessarily care who wins the AI arms race because they sell to everybody globally. Trane Technologies, Johnson Controls International, and Eaton all supply the AI build-out as well. Barron's. Vertiv has been a tremendous stock over the past few years. How do you convince clients it's still a buy after a big run? Davis. Vertiv was never the quality of company that it is today. They were always a number 3 player. If Google put an order in and the top 2 players didn't have enough capacity, Vertiv would get a crumb. Under the leadership of David Cote as the chairman and Giordano Albertazzi as the CEO, they've turned this company into a tremendously powerful liquid cooling, chip-level cooling, electrical infrastructure company. They do a lot of modular units, which is really where the industry's going. And with that, we've come to the end of our reading of Barron's for August 24th of 2026. This is your reader, Eric, saying be well, be safe, look after each other. Bye for now.